You sent over some interesting stuff about using moving averages when we were talking about market technical analysis. And, well, it kind of got us thinking, with everything that's going on right now, what do all those lines on the charts actually mean for what's happening in the stock market today?
Yeah, there's a lot of information out there for sure.
Right. So we really want to kind of cut through all that. And I think what you highlighted was the 21-day simple moving average.
The SMA 21.
The SMA 21, and then also the 200-day simple moving average.
What is the MA 200?
The SMA 200
Yeah,
as kind of
cool.
key levels that you're watching. And so what we wanted to do in this deep dive is actually take a look at how the Dow Jones, the S&P 500, the NASDAQ, specifically the QQQ and the Russell 2000, are all interacting with these levels right now.
Yeah, and just think of it as trying to feel the pulse of the market. And where are those critical areas that could signal a change in direction or some, key levels to watch for some potential moves?
Okay, so let's start with the Dow Jones.
Sounds good.
From what you've shared, Dow Jones futures are currently testing the 21-day simple moving average as resistance. So that SMA 21 is proving to be a little bit of a tough nut to crack for the Dow right now. What kind of immediate signals does that give us?
Well, it's fascinating because the SMA 21 really gives us a sense of that immediate short-term bias, right? And the fact that the Dow is meeting resistance there kind of suggests that the buying momentum we might have seen recently is facing a bit of a headwind right now. So if it manages to break through, that could signal, renewed appetite from buyers in the short term.
So if the Dow does punch through that SMA 21, is that kind of our cue that we're clear for an upward move?
Well, not so fast. If we zoom out and look at the bigger picture, the 200-day simple moving average, that's still the king when it comes to defining the long-term trend, right? So for a real sense that the Dow has some staying power on the upside, we ideally want to see it not just hurdle that SMA 21, but also firmly hold above that 200-day SMA. And that's a much stronger indication that the overall trend might be shifting its footing.
Got it. So short-term hurdle is the SMA 21 longer-term confirmation of strength is really sticking above that SMA 200.
Exactly.
Now, what if the Dow can't seem to get past that SMA 21 resistance? What are the potential consequences of that?
Well, this raises a really important question about the potential downside pressure.
Yeah.
Right? Because if the Dow keeps hitting its head on that 21-day moving average, it implies that sellers are still quite active.
Yeah.
So in that scenario, we could very well see a retreat back down to test lower prices, making that 200-day SMA a really critical support level to watch and see if it holds.
And if the Dow does test that SMA 200 support, what are we looking for there as a bounce off of that level, a good sign?
Well, if the 200-day SMA acts as a reliable floor, it could indeed suggest that those longer-term buyers are still interested, and we might see a potential bounce upwards from that point.
Mm-hmm.
However, if that support were to give way, that would be a more serious signal that the longer-term trend might be weakening.
Okay, so let's kind of sketch out a couple of scenarios. What would a bullish picture look like for the Dow based purely on these moving averages?
So a bullish scenario would play out exactly as we were just discussing, right? First, a solid bounce off the 200-day SMA, showing that longer-term support is holding its ground.
Mm.
Then crucially, we'd need to see the Dow gather enough momentum to reclaim and consistently trade above that 21-day SMA. That sequence could very well suggest a continuation of an upward trend.
And on the flip side, what's the bearish scenario that we should be kind of keeping an eye out for with the Dow?
Well, the bearish scenario would be the Dow repeatedly failing to break through that 21-day SMA resistance that would signal persistent short-term weakness, and it could open the door for a more significant decline, especially if that 200-day support eventually cracks under pressure.
All right, so that gives us a pretty good picture of what's happening with the Dow.
Absolutely.
Now let's shift gears. Let's take a look at the S&P 500.
Okay.
What's kind of the story unfolding there with these same moving averages?
The situation with the S&P 500 is really interesting and perhaps carries a bit more of a cautionary note in the near term. The data indicates that the S&P 500 is not only trading below its 200-day simple moving average, but has also struggled to push past previous price peaks.
Now, trading below that 200-day SMA, I always kind of hear that whispered as like a red flag.
Right.
Why is that viewed with such concern in the market?
You're spot on historically when a major benchmark like the S&P 500 is dwelling below its 200-day moving average. It's often interpreted as a bearish signal, hinting that the dominant longer-term trend might be pointing downwards, and markets in this position often find it challenging to sustain any meaningful upward runs.
And the fact that the S&P 500 hasn't been able to kind of claw its way back to those previous highs,
Right.
What does that tell us about the underlying market sentiment?
That inability to overcome those prior highs suggests that there's still a significant amount of selling interest lurking in the market. It indicates that sellers seem to be stepping in whenever the price tries to rally,
Yeah.
effectively capping any sustained upward momentum.
So for the S&P 500 to potentially shift gears, what are the key technical levels that it really needs to conquer?
Well, in this case, both the 21-day and the 200-day simple moving averages are acting as overhead resistance. So for the S&P 500 to regain a bullish footing, it really needs to decisively break above both of these levels and crucially show that it can stay above them. A fleeting move above these averages wouldn't necessarily confirm a change in the prevailing trend.
What's the bearish scenario we should be particularly watchful for with the S&P 500?
The bear scenario aligns with what the data is currently showing, a continued inability to reclaim that 200-day SMA. And if we also start to see a pattern of lower highs forming where each attempted rally fails at a lower price point than the last, that would strongly suggest that further downward movement is the more probable path.
And on the flip side, what would give us a more optimistic view for the S&P 500 based on these indicators?
For a genuine shift towards an uptrend, we would need to see a strong and convincing closing price above that 200-day SMA. That would be a significant signal that the bearish influence might be waning and could draw more buyers back into the market.
Okay, so the S&P 500 facing some stiffer headwinds.
It's
Stuck below that important 200-day average. Now let's turn our attention to the NASDAQ, often represented by the QQQ.
What?
Is it a similar picture to what we're seeing with the S&P 500?
Unfortunately, yes, the NASDAQ 100, or QQQ, finds itself in a very analogous situation to the S&P 500. It's also trading below its 200-day simple moving average. And just like the S&P hasn't been able to overcome those previous high watermarks.
Now, given that technology stocks have been such a driving force in the market's performance in recent years, what's the significance of this apparent weakness in the NASDAQ?
That's a really critical observation because technology stocks have frequently taken the lead in market rallies. Their current struggle below that 200-day SMA can be interpreted as a sign of a broader risk-off sentiment taking hold. Investors may be becoming more cautious and pulling back from some of the higher growth and often more volatile sectors.
And the fact that the 200-day SMA is also acting as a ceiling, as resistance for the NASDAQ, what could be some of the underlying reasons for that?
Well, the 200-day SMA, acting as resistance here, suggests that there might be persistent selling pressure, potentially originating from larger institutional investors who often use this longer-term trend line as a key reference point for their asset allocation decisions.
So we could potentially see a scenario where the NASDAQ continues to kind of get rejected every time it tries to push up towards that 200-day level.
Precisely, if the QQQ persists in trading below the 200-day SMA and fails to decisively break above it, the likelihood of further selling pressure increases, particularly in those higher beta technology stocks that tend to amplify overall market sentiment.
What would it take for the NASDAQ to kind of regain some bullish momentum, mirroring what we discussed for the S&P 500?
Just as with the S&P 500, a sustained and convincing close above the 200-day SMA would be a crucial bullish signal for the NASDAQ that could attract momentum-driven buyers who were previously hesitant, potentially seeing it as a sign to re-enter the market.
And the bearish outlook for the NASDAQ, is it largely consistent with the concerns we have for the S&P 500?
Yes. If that resistance at the 200-day SMA holds firm for the NASDAQ, then we should anticipate continued weakness in the tech sector. This could be further compounded by any negative news or specific concerns that emerge within the technology landscape.
Okay, so the large cap indices, the S&P 500 and the NASDAQ, both facing challenges below their 200-day moving averages. Now let's turn our attention to the Russell 2000, or the barometer for small cap stocks.
Right.
You're indicating that its situation has kind of its own nuances here?
That's right. The Russell 2000 does appear to be in the weakest position among the major indices we're analyzing. It's trading significantly below its 200-day simple moving average. However, what makes it interesting right now is that it's currently testing its shorter-term 21-day simple moving average.
So being so far beneath that 200-day SMA, what does that generally tell us about the market's perception of these smaller companies?
Well, the underperformance of small-cap stocks, as evidenced by the Russell 2000's significant distance below its 200-day moving average, is often seen as an early indicator of broader economic caution. Right, so small caps tend to be more sensitive to the overall economic climate. So their weakness can suggest that investors are becoming more risk-averse. So the considerable gap below the 200-day SMA really underscores this dampened risk appetite.
And now the Russell 2000 is testing on that shorter-term 21-day SMA. Is that a potential sign of improvement or just another hurdle it needs to overcome?
It's definitely a critical juncture for the Russell 2000. The fact that it's testing the 21-day SMA suggests there might be some short-term buying interest emerging. However, the key question is whether this level will act as reliable support. If it holds and we see a bounce, it could signal some stabilization, at least in the short term within the small cap arena.
And that 200-day SMA you mentioned, it's still quite a distance away.
Yeah.
For the Russell 2000, what would need to happen for it to even start thinking about reclaiming that level?
You're absolutely right. The 200-day SMA is currently a distant resistance for the Russell 2000. So to demonstrate genuine market strength, it would need to not only successfully hold above the 21-day SMA, but also exhibit sustained upward momentum over a period of time, gradually closing that significant gap towards the 200-day average. That would be a strong signal of renewed investor confidence in smaller companies.
So it's the potential scenario where we might see some stabilization for the Russell 2000 based on these levels.
As we discussed, a successful test and subsequent bounce off that 21-day SMA could suggest that small cap stocks are finding a base. At least for now, it would be an encouraging sign if it could then begin to make progress towards that longer-term 200-day resistance.
And the bearish scenario for the Russell 2000, given its already weaker stance?
If that 21-day SMA support fails to hold, then we should anticipate more pronounced selling pressure and a continued underperformance of small-cap stocks relative to their larger counterparts that would reinforce the narrative of ongoing and potentially deepening broader economic caution.
Okay, so let's take a step back for a second and just kind of synthesize what we've unpacked with regards to these indices and their moving averages. We've got the Dow Jones kind of in an interesting tug-of-war testing that short-term SMA 21 resistance while still above the longer-term SMA 200. We've got the S&P 500 and the NASDAQ both below that crucial SMA 200 and struggling to recapture previous highs, and then the Russell 2000 kind of in the most precarious position, significantly below its SMA 200, but currently testing its SMA 21 support. What are the key overarching takeaways from this snapshot, and what should you be keeping a close eye on in the near future?
Well, what's particularly noteworthy when we look at these all together is the divergence we're observing, right? The Dow Jones's flirtation with this SMA 21 could indeed be a leading bullish signal. If it manages to decisively break and hold above that level, it has the potential to inject some upward momentum into the broader market, possibly even lifting some of the other indices.
Conversely, the fact that both the S&P 500 and the NASDAQ are finding it so difficult to climb back above their 200-day moving averages feels like a significant warning sign.
Absolutely. If both of those bellwether indices continue to trade below their SMA 200 levels and fail to convincingly reclaim them, it strongly suggests an ongoing risk of further price declines across the market. That 200-day average carries a lot of weight, both psychologically and technically, for many market participants.
So it sounds like, as is often the case, a degree of patience is warranted.
Yes.
We shouldn't jump to conclusions based on, a single day's trading.
Precisely. It's essential to wait for clear confirmation at these key moving averages. Are we seeing sustained breaks above resistance levels? Or are those levels holding firm, or support levels proving resilient, or are they being breached? These are the questions that need to be answered to gain more confidence in any potential trading decisions based on this type of technical analysis.
So this deep dive has provided us with a valuable snapshot of where the major market indices currently stand in relation to their 21-day and 200-day moving averages. We've seen the Dow Jones testing that short-term resistance while the S&P 500 and NASDAQ are battling below their longer-term averages. And the Russell 2000 is navigating a weaker overall position while testing near-term support.
That's a good summary. And considering these distinct positions, the Dow Jones attempting to push higher while the others face more substantial overhead resistance, it prompts a really important question for you to ponder. What might this divergence among the major indices suggest about the overall health and the likely future direction of the stock market? Could it be signaling a rotation of strength into specific sectors? And what additional information or analysis might help you further clarify this complex picture? Consider how these technical indicators align with the broader economic landscape, upcoming earnings reports, and the prevailing overall market sentiment.
Some great food for thought, as always. Thanks for joining us on this deep dive.
My pleasure.
We'll see you next time.
Sounds good.